You've probably heard it a million times. Invest in your future. But what does that even mean? Most people think they need thousands of dollars to start building wealth, but what if I told you that $7 a day is enough? Yeah, just $5. In this video, I will walk you through on how you can turn something as small as a daily $7 habit into a portfolio that pays more than your salary in dividends. I will show you the best portfolio consisting of 3 top ETFs for this purpose. In the end, I will show you how this portfolio can supercharge a daily $7 investment into a portfolio worth over $1 million. That pays more than $5,000 in dividends every month. But first, why ETFs are great for this strategy? Okay, so why are ETFs such a powerful tool for building wealth, especially with something as small as $7 a day? ETFs, or exchange-traded funds, are like a basket of different stocks that you can invest in all at once. This means you're not betting on just one company. You're spreading your money across many, which reduces your risk and helps protect your investment. Here's the best part. ETFs offer you diversification, low fees, and a hands-off way to grow your money over time. Unlike trying to pick individual stocks, which can feel like gambling, ETFs give you exposure to entire sectors or even the entire market. The real strength lies in consistency. With a daily $7 contribution, you're not only building a solid habit, but you're also taking advantage of something magical: compound returns. Over time, your money makes more money, and that's where your wealth really starts to grow, something I will show with a portfolio in the end. It's a slow and steady approach, but trust me, it's effective. But first, let's make a portfolio, which will have 3 ETFs. Let's start with our first ETF, FTech, or Fidelity MSCI Information Technology Index ETF. This ETF is all about tech, and let's face it, tech is everywhere. Think about the companies you use every single day: Apple, Microsoft, Nvidia, and even companies behind your favorite apps. And with FTech, you're essentially buying a piece of all these tech giants without having to own each stock individually. FTech was launched in 2013, and since then, it's made solid gains in the investment world. Over the past 10 years, it has delivered a staggering 435% return. Just let that sink in. 435%. Now, I know what you might be thinking. Tech is volatile. And you're right. Tech stocks are known for their ups and downs, especially during economic uncertainties. But here's the thing. Long-term, the tech sector is one of the most promising industries. Plus, FTech is affordable to own. With an expense ratio of just 0.08%, you're keeping more of your hard-earned money in the market instead of giving it away in fees. Compare that to the fees you'd pay to own and manage individual tech stocks, and you can see why ETFs like FTech are a smart choice. Moving on to our second ETF, NOBL, which stands for ProShares S&P 500 Dividend Aristocrats ETF. Now, this ETF is all about dividend-paying stocks, and that's something you'll want in your portfolio. Why? Because dividends provide a steady income stream on top of any price appreciation. And who doesn't love the idea of earning money while doing absolutely nothing? So what makes NOBL special? This ETF focuses on companies in the S&P 500 that have consistently increased their dividends for at least 25 consecutive years. I'm talking about some of the most solid, reliable names in the business. Think Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies have a long history of rewarding their shareholders, and NOBL gives you a slice of that action without having to pick these stocks individually. It's a one-stop shop for dividend growth. Over the past 10 years, NOBL has delivered a return of around 124.5%. Sure, that's not as high as the tech-fueled growth of FTech, but here's why NOBL is so crucial. It's consistent. Dividend aristocrats have weathered market storms, economic recessions, and everything in between, all while continuing to increase their payouts. That kind of stability is perfect for long-term investors, especially when you're adding $7 a day to the mix. Stability is key here. Slow, steady, and predictable growth. And then, of course, there's the income side of things. NOBL currently offers a 2.03% dividend yield. Now, that might not seem like a huge number, but remember, this is passive income that's coming in without you having to sell any shares. Not to mention, each year on average, they increase dividends by 16%. NOBL does have a slightly higher expense ratio than FTech at 0.35%, but for the stability and reliable income it offers, it's well worth it. Dividend-paying stocks also tend to perform well during market downturns, offering an extra layer of protection when things get rough. Now for the third ETF, SCHD, which stands for the Schwab US Dividend Equity ETF. If you're looking for a combination of stability and growth, SCHD is a perfect balance for your portfolio. This ETF focuses on high-quality U.S. companies that have been paying consistent and substantial dividends. It's all about getting the best of both worlds, reliable income and steady capital appreciation. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which means you're getting access to some of the most financially stable companies in the U.S. market. Companies like Home Depot, Pfizer, and PepsiCo. These are household names that have a strong track record of paying dividends. And here's the kicker. Over the past 10 years, SCHD has delivered a return of around 115%. So not only are you getting steady dividend income, but you're also seeing solid growth in the share price. SCHD also boasts a higher dividend yield than both FTech and NOBL, with a current yield of 3.38%. This makes it a solid option for investors looking for a bit more income. By reinvesting those dividends back into SCHD, you're putting your money to work, allowing it to grow faster. That's the beauty of dividend reinvestment. More dividends lead to more shares, and more shares lead to even more dividends. One thing that sets SCHD apart is its relatively low expense ratio of 0.06%, which is even lower than FTech's 0.08%. That's practically a bargain, considering the level of exposure and income you're getting with this ETF. And unlike tech-heavy FTech or dividend aristocrat NOBL, SCHD provides a mix of both stability and growth. It's got a solid foundation of established blue-chip companies that offer a balance between capital appreciation and income generation. This makes SCHD a well-rounded ETF that can give you growth potential while also providing solid income. Now that I've covered each ETF individually, let's talk about how these three work together as a strong combination. Each ETF brings something unique to the table, and when you put them together, you're building a diversified, balanced portfolio that offers both growth and income. FTech is your high-growth ETF, focusing on tech. It taps into the rapid growth of technology companies, driving capital appreciation. NOBL is all about stability and income. Dividend aristocrats provide a steady stream of dividends, offering protection during market downturns. While FTech drives growth, NOBL ensures stability with a reliable income. Then there is SCHD, which strikes the perfect balance between growth and income. It's built on blue-chip companies that offer both reliable dividends and long-term returns. Together, these ETFs form a balanced portfolio. FTech brings tech growth, NOBL adds stability, and SCHD combines the two. And now the big question. Can a $7 daily investment with this portfolio surpass your full-time job? Let's find out. If you create a portfolio of these ETFs, your portfolio's dividend yield would be 2.04%, backed by a strong dividend growth rate of 15.36%, and an average share price appreciation of 11.50%. Let's break it down. You're contributing $7 a day, which equals $2,520 a year. That might not seem like much, but over time, compounding is going to work wonders for your portfolio. After 10 years, your total contributions will be just over $25,200. However, with an average annual share price appreciation of 11.5% and 15.36% dividend growth, your investments could nearly double to almost $48,906. In 20 years, this number jumps dramatically. Your portfolio could grow to $250,578, more than 10 times your contributions of $50,400. And after 30 years, things really take off. Your portfolio could be worth $1,229,201, all from just $7 a day. $799,841 of that comes from capital appreciation, and another $353,760 is from reinvested dividends. After 30 years, you would be earning $5,317 in monthly dividends, or $63,810 per year, without having to sell any shares. That's a steady stream of passive income, potentially replacing your full-time job. In total, over the long term, you would have invested $75,600. From there, the portfolio would have grown by $1,153,601 over 30 years. Want to know how to turn a $10,000 investment into a multi-million-dollar portfolio with ETFs? Click the video on the screen to find out.